Hello, everyone. I think we have begun the webinar officially, so I'll just get started. But I wanted to thank everyone for joining us for this very special session of our monthly PolicyMap office hours. We are joined by quite a star-studded group of individuals, and I want to thank all of you for joining us today to talk about one of the most pressing issues that the country is facing right now, the housing shortage, housing affordability. We're going to start with a high-level look at where we are right now in terms of the housing crisis. We'll then do a deeper dive into census-tract-level data that we recently put together to identify specifically where in cities across the country we have a housing shortage issue, in some cases a housing surplus issue. And we're going to learn more about how Philadelphia applied that data to their ambitious housing plan. So before we get started, I'm going to look at my notes because I have a couple of housekeeping items. The first is that this is a webinar that's being recorded, and so we will send out a recording afterwards. The second is that this is a Zoom webinar, so everyone is on mute. But there is a Q&A button at the bottom of the screen where we hope that you will put in your questions. Third, we are going to try and make this as interactive as possible. So we are going to entertain questions during the course of the presentation. So please type in your questions. Phil Vu is with us, and he's going to monitor the questions for our panelists. And after each panelist talks, we'll have an opportunity for Q&A. We won't just be waiting for Q&A at the end. I think that covers all the housekeeping items. So we'll get started. Before we jump right into the webinar, I would see if everybody would like to introduce themselves. Mark, Zandy, if you would like to go first, that would be awesome.
Sure, Maggie, and thanks for having me on. I really appreciate the opportunity. Of course, I love PolicyMap, PMAP, and for the sake of disclosure, I'm on the board. I'm the lead director, and I'm also, for sake of disclosure, I'm on a publicly traded company board, the private mortgage insurance company MGIC, and of course, the chief economist of Moody's, with a lot of interest in housing and housing finance over the years. So, thanks again for the opportunity.
Thank you for joining us. Ira?
Good afternoon. My name is Ira Goldstein. I'm with a newly formed consulting group called IJG Urban Advisors. And when this work was done, I was working with my old friends at Reinvestment Fund.
Good
Angela.
afternoon. Good afternoon, everyone. My name is Angela Brooks. I am the Chief Housing and Urban Development Officer for Mayor Sherrill Parker, the City of Philadelphia. Pleasure to be here.
Thank you all. And I am Maggie McCullough, CEO and founder of PolicyMap. Many of you, for those of you that don't know us, we vet and aggregate data from public and proprietary data sources throughout the country to be able to give people insights about what is happening in communities across the United States. And that can be done within the PolicyMap platform and more frequently now within the places where you are working. Our goal is one source of truth wherever you're doing your work. And so if you're in Snowflake or Salesforce or soon Claude, you'll be able to access and analyze the data to gain the insights that you need for your work. So with that, unless anybody has anything else they want to mention up front, I think we can dive right in. Yeah, okay. So I'm going to share my screen.
Should I get going, Maggie?
Yeah, I'm going to share the PowerPoint.
Got it. Well, Maggie asked me to talk about kind of the housing affordability crisis at a high level, at a national level. And at a national level, the crisis remains very serious. You get a clear sense of that here in this first chart, which shows the ratio of house prices, the median house price to median incomes over time back to 1970. Historically, the kind of the rule of thumb has been an affordable, reasonably affordable single-family housing market had a price to income ratio of about 3.5 times. And you could see that kind of was where we were back in the 80s and 90s, and abstracting from the housing bubble before the financial crisis. We were around that level. It's risen quite considerably since the trough coming out of the GFC, the global financial crisis, peaked 3, 4 years ago now, when the Fed Reserve started to jack up interest rates coming out of the COVID pandemic. You can see we got to almost 5.5 times. Things have improved a little bit. It's moving in the right direction, but still close to 5 times. So, certainly by this measure, affordability remains a very serious problem. I won't go into any detail, but you can see in the table embedded in the chart some data for various metropolitan areas across the country, including Philadelphia. It's one of the more affordable housing markets. Now, one quick caveat. A lot depends on the geography of the metropolitan area. In the case of Philadelphia, this includes Philadelphia County and Delaware County. It's the division, the metropolitan area division. It would look a bit meaningfully different if we threw in the suburban ring, but that gives you a sense. And you can see I showed 2 periods in time, 2019 and the most recent data in 2026, and the house price income ratio is up everywhere. Affordability is a nationwide problem. There's only 3 ways out of this conundrum, this crisis. One is weaker house prices. Now, we are getting some weakening. National house prices are growing 1, 2, 3% year over year, which is below the rate of inflation. So real house price growth is falling. We've got to be careful here. We don't want prices to fall in a significant way, because that would put obviously tremendous pressure on homeowners who are relying on their homes as a source of wealth. And you have a lot of new homeowners who became homeowners in the last few years, put very little down. And if we see some price declines, they could quickly become underwater and become a credit problem, and may be an issue for holding on to the home. So we're kind of limited on with regard to house price growth in terms of helping with regard to the affordability crisis. The second way is through more income. That means jobs and a continued strong labor market. That's the best way. We need to avoid recession, see continued income growth. But even if you do see kind of typical income growth with kind of flat house prices, it's going to take quite some time, 3, 4, 5 years, for affordability by this measure to get back to something that we all feel comfortable with. The third way is mortgage rates. Here, you can go to the next slide. I don't think I'd count on mortgage rates coming in anytime soon. In fact, most recently, because of the restart of the Iran war and the run-up, the subsequent run-up in oil and gasoline prices, we've seen Treasury yields rise. That's the 10-year Treasury yield is the green line here, and this is data back over the last 10 years. Last data point was for last week, and you can see we're now closing in on where we're about 4.5, 4.6%. So kind of on the high side of where we've been over the last couple, 3 years. And now you can see mortgage rates. That's the blue line. That's the 30-year fix. That also has pushed up. We're actually closing in on 7%. At 7%, it's going to be very, very difficult for homeowners, new first-time home buyers to get into homes. Affordability is going to remain a very serious problem for longer. Now, I do think rates will come in once we do get to the other side of the Iran war, and probably settle in around 6%. If that's the case, that'll be okay. It'll take 3, 4, 5 years for us to kind of restore affordability. But so I wouldn't count on mortgage rates, kind of bailing us out here. They're neither here nor there. We need to see continued income growth. You can go to the next slide, Maggie. The kind of the fundamental problem, with regard to the affordability crisis, is a lack of supply, both in the existing housing market and the new market. In the existing market, you can see why that's the case here. There's significant interest rate lock. A lot of homeowners got into their homes, refinanced their mortgages back when interest rates were very low. During the teeth of the pandemic, the 30-year fixed rate got down to 2.5, 3% at different points in time. And they're in no position to move at current mortgage rates with, the 30-year fixed back close to 7%. And you can see this real interest rate lock effect here in recent years. The green line is the current mortgage rate. The blue line is the effective rate on outstanding mortgage debt, on existing debt. You can see we're at 7% on the 30-year fix. We're at 4.5% on the existing debt. that's a pretty big gap. And when you have that kind of gap, households that are homeowners aren't going to be able to move, and that limits supply. This is particularly a problem in the Northeast, and Philadelphia is a good case in point. Midwest and on the West Coast, that's where the interest rate lock is most pronounced. There's other reasons for the lock, capital gains, taxation. We can talk about that if people are interested, but a lot of different factors that are causing the supply side of the existing market to remain very constrained and making it more difficult for the market to adjust and address the affordability crisis. And finally, in the last slide, I want to show in the new housing market, we also have a pretty significant deficit, an undersupply of housing, and that's what's illustrated here. This shows our estimate of the over or undersupply in the overall housing market, both for home ownership and for rent. And we've kind of broken that down in the colors in the bar. The blue part of the bar is the homeowner or for sale market. The green part of the bar is the for rent market. And you can see we've also constructed an estimate of what we call pent-up households. These are households that have not formed because it's just unaffordable to do so. Either they can't either to buy or to rent. So we've seen a lot of doubling up, kids living with their parents, and so that is kind of a shadow vacancy that's plaguing the market. You can see our current estimate of the undersupply at this point, adding it all up for the sale market, for rent market, and the pent-up households is about 2 million homes. We just got another data point today for the second quarter, and it looks like this gap will come in a little bit more. We're doing some work on that, but I think a good round number is about 2 million homes. So until these supply issues resolve themselves, or potentially if policymakers are able to address them, I wouldn't hold my breath for that. But obviously, a lot of folks in Philadelphia are working hard to address that. Nationwide, it's very, very difficult to do so. But barring a game-changing policy shifts, it's going to be very, very difficult to address this affordability crisis anytime in the near future. It's going to take a number of years to kind of right things and get the housing market back on more solid ground. With that, Maggie, I'll stop and I'll turn it back to you.
All right, Mark, thank you. We do have some questions that came in. Phil, are you able to field them for us?
Yes. Yeah. This one's going to be a little explanation. So let me just read it for you, and hopefully you can expand on. I think they're hoping you can expand on some of one of the slides a little bit. Alejandra stated that the very first slide in discussion underscores an important tension with the supply argument, given the sharp increase in house prices to income ratio when construction was strong, pointing to speculation and financialization. Similarly, wanting housing to appreciate in value for wealth accumulation, given weak social safety nets in the U.S., is a direct tension with the affordability goals. I'm hoping that you can expand a little bit or comment on that bit.
Yeah, I know you're exactly right. I mean, if you're a homeowner, if you're already owning your own home, obviously you want to preserve that house price. You want house prices to rise and rise as much as possible because that goes to your wealth. And for many households, middle income Americans, the home remains the single most important asset and the key to wealth building. But at the same time, if house prices are too high relative to incomes, as shown here, it locks out potential first-time home buyers and will ultimately result in a lower home ownership rate. Fewer people can be able to become homeowners and enjoy that wealth building benefit of owning a home. So it is a tension. It makes making policy very, very difficult, certainly from a political perspective, because you have very different constituencies with very different kind of interests here. And that's why, I think it's ideal if kind of house prices were to go, and what they have been doing over the last couple, 3 years, is kind of go flat here, maybe up a little bit, a point or two, percentage point or two, which is what we're getting. Not, that means some price declines in some parts of the country. It means price increases like Philadelphia. We're seeing price increases, but net across the country, it's basically flat. That's probably where we want to keep it in terms of house prices, and we really want to see those incomes grow. There are segments of the housing market, though, where it would be advantageous to see a lot more supply, where house prices, have been rising more quickly and affordability more of an issue. And that goes to Ira's going to be talking about some of the results that we got based on the research that we've done around workforce housing, workforce rental, workforce single family. So but you make an excellent point. It is a difficult tension, particularly with regard to making policy that can work both from a policy perspective and a political perspective.
Wonderful. It's
Thank
fantastic.
you.
Yeah. So there's a lot of questions coming in. So I'm just going to try to capture maybe one or two questions, and then we can get Angela and Ira as well.
Yeah, and
And we'll have
we will
plenty of time at
answer
the end.
all of these questions afterwards that we don't get to. Yes.
Yep. So Jeremy and another person asked about, is there a way to calculate a number of pent-up households at the local level? And then somebody was just generally asking about what's the methodology of the pent-up household metric?
Yeah, great question. And the answer is we've done it. We've taken the Maggie, Ira, Chris Streety's my colleague at Moody's, have done this work. We wrote a paper. Maggie, I can't remember when it was. It's about a year ago. We published it.
Mhm.
We are updating it now. Maggie will go over that. And I just got some Maggie hot off the press. Chris, based on today's data and the new ACS data, it looks like the housing shortage is down to about 1.7 million, of which 1.1 million is our estimate of pent-up households. And the questions is putting the finger on the right thing. Estimating those households is not easy. And what we do is we look at the headship rate across age groups. Uh, we take a period in time historically, which we consider to be kind of a typical time, cuts through the business cycle, what we call the equilibrium period of equilibrium in the housing market, and use that as compared to the current headship rate to get our estimate of the pent-up households. There's a couple of other adjustments because we want to make sure that we want to capture cyclically related changes in headship rates across age group, not kind of more structural, durable changes. And so we make a couple of adjustments with regard to that. But that's roughly the methodology. But you can see the gory details in the methodology in that paper, and I think it's in the appendix of that paper, and we'll flesh that out in the update that we're doing now.
Thank you.
Perfect. Maggie, you want one more question? Do you want to go?
Actually, the one question that I wanted to ask, because I'm also really curious myself, is if how you see the latest housing acts impacting any of this. What do you see as what we might hope to expect from that?
Yeah, this is the 21st Century Road to Housing Act that
Correct, yes.
Congress passed. The president didn't sign, but he didn't veto it, so it became law. It's small ball in my humble opinion. It's not going to, it goes to my point I made earlier about national policy. It doesn't feel like that's going to move the dial anytime soon. I don't want to be too critical though, because if you look at all the various elements of the bill, and there are many moving parts, all of them are reasonably good, from my vantage point. I mean, for example, the provision I find most attractive and potentially could lead to more supply where we need it is around manufactured housing. There's a chassis rule. I know I don't want to go too deep into the weeds, but that was changed to allow for more modular housing, more manufactured housing, which is a very small part of the housing stock. I mean, if you look, only about 100,000 manufactured homes are produced and placed every year, and that's typical year you get 1.67 million homes that are put up, single, multifamily, and manufactured homes. So it's a very small part of the pie, but it could be a much larger part, particularly in that going back to workforce housing. We need more workforce for rent and for sale, and that could be a way of doing it, particularly in the South and the West, where manufactured housing is a much larger share of the housing stock. That's just one example. There are many others. I will say one reason for my skepticism about is being able to move the needle here in the near term is that a lot of it requires HUD to do work and implement it, and HUD does not have any resources. And of course, the administration has been cutting back on HUD's budget. and cutting staff, right? So HUD's historically had a very difficult time getting things across the finish line because of budget issues. Now it's even worse. So even if you like the provisions, which I do, it doesn't mean that they're going to get implemented because there's no one there to implement it. So
Right.
unfortunately, it's unfortunate.
Yeah. Mark, thank you very much. That's
Sure.
been it's like having a rock star join the team once in a while for
With
these
no
things.
hair,
So
rock
it's,
star with no hair. I'll take it. I'll
I'll
take it.
take it. I'll take it.
Yeah.
That's right. All right. Thank you. So I am going to quickly go talk about a little bit about the study that we have been referencing so far. Ira is going to do a much deeper dive into this census tract level study that we undertook. I just want to talk about why we undertook it, and Mark alluded to some of this in his conversation. What some of the high level findings were, and how, this data, we know it's only one piece of information, how it can be used in combination with other data to really identify opportunities at a local level. So, off the bat, why we undertook this was we knew that national housing shortage number that Mark shared, that 2 million housing units short, is it's not just a single big number, right? It's distributed across the country in very uneven ways. Some places have shortages, some places have surpluses, actually, and it varies by cost, by location, and by tenure, whether it's a rental unit that's in need or an owner unit that's in need. And so we really wanted to figure out if we could quantify at a census tract level where the need and what kind of need really existed. Um, Second was, and Mark alluded to this, is that national figures are really of limited use for policy and investment. We know that housing decisions, right, where to build, what to build, and for whom, generally happen in localities. Those are decisions made at a local level. And a national number is just not going to be informative to a builder, city council person, or a developer, a lender, whoever, to actually help understand there's need in this community. So to cut through all of that, we analyzed cities, again, at the census tract or neighborhood level to really understand, A, where is housing most needed, neighborhood by neighborhood? Is that need for renter or owner occupied housing? And are there big differences in the housing needs based on the income level in a neighborhood? So those are the three things that we set out. And we do refer to this as a housing gap study, because as I mentioned, there are places that have housing shortages and there are places that have surpluses. So overall, in the study, we looked at 350 cities in the United States. We limit it to populations with over 100,000 people. And we did this twice. We did it first in 2025, which is when we issued the study. And then we did it again. We reran the numbers with the latest data in early 2026. And the findings were consistent as we would have expected across both years. So these cities, so no, it's not the full national number that Mark talked about. It's these 350 cities. They need 830,000 more housing units, which is about a 2% gap. Another finding was that this shortage in these cities, it's primarily a rental one. 64% of the needed units are renter units. And when we looked at it by income, this is where Mark was talking about workforce housing or moderate or middle income neighborhoods. They are bearing the brunt of this housing crisis. Those neighborhoods contain 67% of existing rental units, but they account for 87% of the rental shortfall across all these cities. So they are disproportionately burdened by the need for more rental units. When we looked at high income tracts, they definitely need more owner units, but they do appear balanced in terms of rental units, except when you get to large cities. Large cities, high income tracts in large cities tend to have a surplus of rental units, suggesting they were overbuilt. And so that's another thing about sometimes the national numbers. Places with surpluses and places with need could get mushed together. and the need gets masked, right? So taking out the high income rental units was an important part to be able to distinguish where those existed, versus where there were pockets of need. And then lastly, when we looked at low income tracts, things appeared pretty balanced, both in terms of owner and renter. We had a lot of conversation about this amongst our team members. And we believe that it may be due to new construction that's happening in low income tracts that's not actually affordable to the people who live there. And it may also be some positive impact of the long-term affordable housing programs that we've had in place in this country, and that maybe there's some combination of the two of them, but it was in the data. It did not look as if low-income tracts were in the greatest need. At the greatest need was really that workforce housing, that middle and moderate and middle income neighborhoods. And so, as I mentioned, we know that this is only one piece of information that localities or developers need or want to think about as they identify opportunities for development and investment. And so, just by way, as an example, we're looking at a map of Dallas, these purple shaded areas are census tracts where, the bottom of the screen did not appear, where these are census tracts that have the highest rental need in the city of Dallas. They also have a median gross rent somewhere between $1,000 a month and $1,500 a month. So they're sort of in that mid-range. And there's some tax incentive for doing work in these places. In this case, I put up new market tax credit eligibility. We know new market tax credit is really primarily used for commercial investments, but we know that there are some CDFIs and others who are figuring out how to use new market tax credits for housing development. And so it's an important piece of information, but this could just as easily be opportunity zones or other kinds of tax credits that are available at a local level to pinpoint need. It's the right market with this rent range, and it's sitting in a place that could be tax advantageous, a place where I could do development and receive a tax benefit. And so our hope in creating this census tract level data was to really get it out there, get people using it, and enable them to sort of marry it, for lack of a better word, with other data that could really help them zoom in to places where investment made most sense. And that was my very high level overview of the housing gap study, why we did it, the high level findings. Ira is going to go next into a deeper dive into the study, but if anybody had any questions about anything I said, I'm happy to entertain them.
Yeah, there's actually a question I'm guessing maybe everyone can try to answer. It's really about the data from the census, or from the federal government. So if we're worried about the effects of quality of data happening in the federal government or so.
Yes, I think that we're always definitely in this time worried about not just quality, but perhaps the frequency of updates or data sets that are potentially going to be discontinued. To date, the data that we've used for this study, we feel good about. I think Ira will talk about the sources. American Community Survey data at a census tract level is, as the name implies, survey data. So it's always going to be a little, it's not an exact science, right? But it's as good as anything that we have right now. I think we feel very confident in that ACS data, and I don't see any reason to expect at this point that will not continue. And then there are proprietary data sets out there that if we were to lose one of the public data sets that we've used in creating this indicator, I think we could find or sort of piece together alternative data that could work. But yes, to answer the question, we are definitely always worried about continuation and reliability and updates of federal data sets.
Wonderful. Yep.
Awesome. So Ira, oh, okay. I had to just do that. Okay, fine. Ira. you're up.
Thanks, Maggie. Um, so what I'm going to show you now is a result of Maggie and I essentially applying a logic that Mark and his team at Moody's and one of his research colleagues, Jim Parrott over at Urban Institute, came up with as part of the logic of how they estimated the housing shortage in the United States. And as Maggie mentioned, we sort of approached it from the perspective of if I'm in Angela's seat, for example, in the city of Philadelphia, we have to make a lot of decisions about where we're going to incent or disincent or provide for housing to be created or preserved in certain parts of a city. And to know that the city itself needs X thousand units is great, but to know where those needs are greatest, and by the way, where there are not only not needs, but there's an oversupply is an important piece of information for designing policy as well. So what we do is basically adopt their logic in this way. There is the notion, as Mark alluded to, that there is an equilibrium period in the housing market. And he and his colleagues essentially tested a variety of different ways and came to the conclusion that in the housing market, the equilibrium period was roughly that period 2012 through 18. And why it was after the housing market had sort of settled after the crash of 2010. As you saw in Mark's slide, the interest rates were like relatively steady. Price appreciation and construction had gotten back to more normal kinds of levels. And frankly, cutting it off at 18 was a way of essentially making sure that the data that we would define as the equilibrium period wasn't distorted by the pandemic, which, as we all know, we've lived through it. It really created havoc in the housing market in a variety of ways. So that becomes the equilibrium period, and that is the standard against which places are compared. Before I sort of go further into that, we wanted to also talk about what is what are we looking at the equilibrium period of, and that is of vacancy rates. And I think one of the big important notions here is not every vacant unit is a vacant unit that's available for sale or for rent. You could easily sort of think of places where half a town is empty from November to May because it's a shore town. Well, those vacant units really aren't necessarily available for people. So there are seasonal vacancies. There are also homes that are sold or rented, but they are vacant. And so they're not available as another housing unit to sort of go into the stock. And lastly, there's another category of vacant that the American Community Survey describes, and that's what's called other vacant. And our experience there is that those other vacant properties were the kinds of places that if you sort of think about the cities that you live in, if you are in a city that like Philadelphia or other places that we've had the pleasure of working, they might be the places where there are concentrated abandoned properties. So the kinds where you drive down the street, you look through the front window of the house and you can see the sky through the ceiling or through the roof of the property. So those, while potentially are available, may in fact take more financial investment than it might actually be possible to turn them into viable units. So the definition of vacant was important, and the identification of the equilibrium period was important. Could you change the slide now? And so then what we did is on a city by city level, we created what those vacancy rates were for the total housing stock, for the rental stock, and for the owner stock. The numbers that you're seeing in that chart there are just a sampling of cities and what their respective numbers are. One generalization that it's fair enough to make out of this is in virtually all of these cities, the renter vacancy rate is higher than the owner vacancy rate. And so what that tells us is in normal market periods in most cities around the country, it's more typical to have more vacancy in that rental stock than it is in the owner stock. And so what we do is we have these city level vacancy rates for total owner renter, and we compare essentially each census tract. You can change this slide now. We compare each census tract essentially to what the city's respective vacancy rate is. If it has more vacancy in the census tract than you see in the city's equilibrium period, then the area is oversupplied. If it has less vacancy, then the area is undersupplied. And that's the basic logic. As Maggie said, in most cities, the shortages are more severe in the rental stock, and they are generally disproportionately more in the modest middle, a bit lower, with some caveats to that. And I think that our observation is that in most places on the highest end of the market, the builders and developers have been able to sort of meet that demand. But where price points are lower, and it makes it harder to sort of create profitably that housing stock, then the ability to meet that demand has been less good. Next slide, please. And so here are a few of the, again, sort of a sampling of cities. What we had observed in Philadelphia, which is the yellow highlighted place, is that we found that there were about 6,639 units short in areas of the city where there is a shortage on the owner side, and about 11,739 units of renter housing short in areas that were short of rental stock. On the other hand, there were some oversupplied places. And in those oversupplied places, you get 1,726 excess, if you will, owner units, and about 4,650 excess renter units. Now, the challenge is, as Maggie said, these things are not interchangeable. So a vacancy in a very high rent place is, it's important as part of the stock, but it's not necessarily available to somebody who has an earning of $45,000 a year. That's not a useful vacancy for them. So to be able to sort of understand where the overages and underages are helps you get at what needs to be done in terms of the creation and ultimately, frankly, the preservation of the supply. And one of the things that we wanted to point out with this is there are some places actually where the overages actually are greater than the underages or the shortages. And, as we were sort of going through the validation of the work, we looked around a few of the different cities, and no sooner did you look at Dallas or San Antonio or Milwaukee or Boston, for example, where we were seeing some overages that were a little bit surprising to us. You find these headlines that, they're oversupplied, rents are softening. Right. Next slide, please. So we're going to show you just a couple little sample cities here, not little cities, a couple sample cities, this one being the city of Pittsburgh. On the left, you're looking at the estimates of the shortages or oversupply in the owner stock, and in the right, you get the rental stock. If you see white on the map, it means that it's pretty much in balance. And if you see anything in a purple shade, the darker the purple, the more the overage. If you see anything in a gold or a brown tone, the more the shortage. So what I think is fair summary of the left side, that's Pittsburgh's owner occupied stock, they're actually in pretty decent balance vis-a-vis their equilibrium vacancy rate, and actually are in some places, some parts of the city, a bit oversupplied. That's very different than if you turn to the right side, where you're looking at the rental stock, where you see some places where there's been some oversupply, like in the sort of the strip district sort of going up and to the right out of where the name Pittsburgh is on that map. There's been a lot of development in there, and it's now showing signs of oversupply. On the other hand, what you also see is some of those brown tones, and that means that there are parts of Pittsburgh where the rental stock is short of what they need to get back to what they had when the city's stock was in equilibrium. Next slide, please. Next slide. Here what we're looking at is the city of Boston. And again, on the left, you see the owner-occupied stock. And what you'll see is very much like Pittsburgh, it's actually clocking very close to what its equilibrium period would be. It's mostly a white map with a little bit of purple, which means that those are oversupplied places. On the other hand, you have the rental side, which is on the right side map, and there you're seeing, a fair amount of that, those brown tones, and those are places where the rental stock is undersupplied. And I want to be really clear here, and I'm going to come back to this point again. We are not doing this necessarily vis-a-vis where somebody could afford to rent, because you could have shortages in certain places, or actually overages in certain places, but it doesn't mean that it's necessarily accessible or desirable to the people who are looking for housing. Next slide, please. And now we're looking at the city of Detroit. Again, on the left, you're looking at the owner-occupied stock, and on the right. And the picture of Detroit is actually quite different. For those of you familiar with the sort of the recent history of Detroit, if you look at where it says Windsor on the map and Detroit, where those two labels are, that really is sort of basically the downtown core of Detroit, running up to the northwest, Main Street that runs you up through the city of Detroit. On either side of that, you're seeing some purple, and you're seeing some purple in and around the downtown. That is where actually there has been construction in the city of Detroit. Same thing, more or less, on the map on the right, where you see actually a concentration of oversupply in that place. But that's where most everything has been taking place in Detroit. Where it hasn't been taking place in Detroit, on the owner and the renter side, what you're seeing is there's shortages all around. Next slide, please. And now we're going to get to city of Philadelphia. And so here we're looking at the owner stock, and basically we have a few spots in and around the downtown core and some of the expansion areas of downtown, where there are oversupplies. And this is where construction has been gangbusters in these places, probably for 8 or 10 or 12 years. You also see some areas to the east in the city, sort of across and above where it's got the label for the city of Camden, where there has been a fair amount of construction and oversupply. And you can go to these places and see that there are concessions on the rental side with concessionary rents. And on the owner side, you're seeing, seller financing of closing and a variety of other things. But basically, the picture of Philadelphia is one where we have some oversupplied areas and modest undersupplies in the owner stock. If you go to the next map, which is going to be the renter, here you're seeing much more severe shortages. And this was really important, I think, for purposes of when I do this handoff to Angela, because the mayor had this notion of, let's use the term for this moment, treating 30,000 housing units, either creating or preserving those 30,000, but being able to know how many of them needed to be owner occupied and how many of them needed to be renter occupied. And because we have all these numbers for every census tract in all these cities that Maggie described, we can even know with respect to what are the income levels in and around those areas where you see those shortages or oversupplies. That helps Angela and her team be able to start making plans and strategies and developing tools and the like to be able to address these undersupplies in sort of the tenure types and price levels that she needs them, as well as, by the way, other investors in the city looking at where some of these oversupply areas are and essentially exploiting that as market actors will, because in the right circumstance, perhaps you're able to get access to a housing development that is not selling because it's an oversupply or renting because it's oversupplied. Next slide. And I'm just quickly, I'm not going to go into all the numbers in here, only just to say this is an illustration of what we did. We took all of those shortage measures. We were able to stratify them to the income levels of the residents who live in those places, and then be able to describe for Angela and the mayor and her team on this plan how many units she needed to be able to create and to be able to meet, but not only to create, but at what income levels she needed to be able to sort of make this creation happen. Obviously, when you look at higher end housing, the need to incent that, the need to invest in that substantially from the city's perspective is much lower than the need to make those investments in places where the market prices, be they the sale prices or the rent levels, make it not viable without the support of the city. So with that, I'm going to stop. I don't know if you have any questions.
There is quite a lot of questions, so I just want to reiterate to
No
everyone,
answer.
we will definitely try to answer it back. We don't get to your question, but I'll just give one in the case of time that we have today, which is there an assumption of an idea renter to owner ratio in a city or tract, or is shortage overage based on existing residents in that?
It's all based on that historical pattern. So there's no notion of what's ideal in a place or what's aspirational in a place. It's basically measuring us against an earlier time that we think is sort of a normal time in the city's history or in any of the city's histories.
Great segment to Angela.
Great.
Is this your slide too, Ira?
Yeah, but I'm going to skip it for time.
Okay. And here is Ira's contact information, which we will send out everybody's contact information, along with the recording, if that's helpful for folks.
Great.
And Angela, there you go.
Great. Well, first, thank you guys for organizing this and giving me the opportunity to really talk about Philadelphia Home Plan. We can go to the next slide. And so, as Ira mentioned, when Mayor Parker took office, she had this great goal based off of her experience as both a state legislator and city council member. But one of the things we learned when we started drafting the plan behind that was just it helped us flesh out this 30,000 number. And that's how we came up with kind of what we were needing to address, which Ira just kind of went through. And so we kind of see some of the units, they've changed. Ira, I was looking at yours and I was like, oh, that's kind of depressing because they didn't change in a way that I necessarily love. But at the end of the day, it's not just numbers. They're really representing kind of the families that are having to choose between housing and healthcare, housing and any number of things. And so the mayor is very passionate about ensuring that Philadelphia is a place that people can afford to not only live and to thrive. And so we were tasked with kind of figuring out where that kind of leads. You can go to the next slide. And so our housing plan and how we started to use the data is really, we have the tract level vacancy gap analysis, and Philadelphia has 10 council districts. And so as we started thinking about where we need to deploy things and what we need to deploy, we started noticing the trends and where they were. And this became really important as we started thinking about how we navigate the political side of the work we did. Part of our housing plan is we were asking the city to do an $800 million housing bond to fund this. And while the mayor and city council do both agree that we do have a housing crisis, kind of needing the data to back up why we need to borrow $800 million and create debt service was pretty important. And so we really used a lot of the kind of transitional, strong, middle, lagging and regional choice to understand the different neighborhoods. And I should also mention, I am at that time, I was brand new to Philadelphia. It was particularly helpful to me as I was leading that because I knew very little about Philadelphia. So as somebody who was a Philadelphia transplant and needing to understand the housing market, it was super helpful to me. As a part, I would say, of my onboarding, I probably spent more time with Ira when I first started than anyone else, just really nerding out on some of the data points. And so I think looking at where the shortages were and then looking at how we deploy our city-owned land and our funding became a pretty important part of the data usage. You can go to the next slide. And so as I kind of referenced, we, over the next 4 years, are looking at 30,000 units. It is to restore, repair, or produce, or create or preserve. $2 billion commitment. As I mentioned, we have an $800 million bond. We have about $1 billion of city-owned land that we're going to make available. And then we are also looking for our philanthropic partners to kind of pitch in on the other portion. And so we've got some pretty big programs that we're utilizing. So Turn the Key is kind of our signature program for creating home ownership. We provide land, city-owned land to developers. They produce a brand new home, 3-bedroom, 2-bath. The maximum sale price of those homes is $280,000. The city then does a forgivable grant would be the easiest way, or a soft second for those of you who are nerd out on like the numbers, of about $75,000. We've got the Philly First Home, which is a $10,000 grant. So somebody can get a brand new house for about $195,000. And so we really were looking at how we could empower that and looking at where we owned land, where those numbers work. And certainly we are only doing those in neighborhoods where there is homes that are selling at or above that 280 price point. We are using this as a tool for preventing displacement, not creating it. And so the data really helped drive where the city-owned land that we should utilize that would go. We are also looking at where the neighborhoods that were some of the existing programs we have, like our basic systems repair, our restore, repair, renew, which are some of the it's a lower income, or not a low interest rate loan program that can help people restore their homes. But mostly Philadelphia having an older housing stock and being able to really establish that preservation had to be our focus. Because I think ideally some people were thinking when we first started this, it would be production. But we recognize that the most affordable home you can have is often the one you already own. And part of the reason Philadelphia has a relatively more affordable rental stock than other cities in our region is because of the older nature of our homes, and having the data to kind of back that up and drive that was really, really important. You can go to the next slide. And so really kind of looking at all of the different markets in Philadelphia. As I mentioned, I was super new, so I had very little knowledge. So it was helpful for me to understand the kind of layout that we had to figure out where things needed to go. We also have a mayor that's hyper-focused on our workforce. We have a residency requirement, so we needed to look at the programs that support the city workforce, as well as just as an economic driver for economic development for the city. So we use kind of these market tools to figure out what programs go where. A lot of the work that we're doing now is around marketing and kind of thinking through that. But it also helped us with our conversations with our district council members to help them understand, certainly if you're an elected leader, you understand your neighborhood and the area you're representing, but sometimes you don't pay attention to like the market conditions. So it was a really good tool to help us work with council members to kind of understand, hey, these are why we are proposing these programs in your neighborhood. Here's the data to back it up. And one of the things the mayor is hyper focused on is third-party validators, because I certainly would say or consider myself an expert, but I work for the mayor, so I don't know that everybody wants to agree that I'm an expert. So I drop Ira's name all the time, and now Maggie's as well, because they are not city focused, they're external, they are third-party validators that really help support and drive the initiatives that we're forming. And, I think one of the biggest things that we walked away from is that I think very often in housing policy, we look at kind of a one-size-fits-all solution. And this really helped prove that not every neighborhood needs the same solution. And we needed to kind of figure out where that is. And the biggest thing we are hyper-focused on here in Philadelphia is preventing displacement. We want to ensure that our naturally occurring affordable areas, which are often naturally occurring affordable because they're not in the greatest condition, that as we invest in those communities, we aren't creating tools for displacement as they're seeing investment. Next slide. And so we spent a lot of time diagnosing the issues. Then we designed the home plan. One of the things that we definitely looked at is we as Ira and Maggie both mentioned in their presentations, a lot of the identification was recognizing that certainly we have obviously a hyper focus on a lot of programs that are kind of that 0 to 30 AMI or 30 to 60, but we recognize that we have people that were above most of the income limitations of a lot of our programs that still were cost burdened and that they were needing immediate assistance. So part of our plan was looking at what programs do we need to expand the area median incomes. And so for our basic systems repair, which is kind of emergency repairs for homeowners, and our adaptive modification program, which does kind of think accessibility assistance for lower income homeowners, we expanded those AMIs. So the adaptive mod went up to 80% of the area median income, and our BSRP actually goes up to 100% of the area median income. And where the data was very helpful in that we definitely don't necessarily have political agreement on income expansion, to put it lightly. But having that third-party data, when council had the opportunity to change those, they didn't change the income expansion. They certainly capped the amount of money that we could allocate from the bond to that, but they recognized that we did need to help some of those families that are above our traditional income limits that were cost burden. And so we legislated it. We had our home ordinance, which was the authorization for the bond, but also our housing plan. And now we're in the process of deploying it with 6 partner agencies. And we're also doing a home optimization plan, which is really looking at what are the barriers within the city that really create some of the housing supply issues in terms of regulatory barriers. So we're looking at zoning reform, but we're also looking at systemic reform through a lot of our departments that touch housing. Next slide. And so, these tools really kind of helped us get the vocabulary to describe our housing crisis in terms that are not so political and not as much I work for a mayor, so everything becomes kind of political. But home is a response, and home is housing opportunities made easy. It's probably not the best name for people who work in housing because they think about the federal home housing source or funding source. But it is a $2 billion plan over the next 4 years that will really drive all of the housing work that's done in Philadelphia. The work's ongoing, and we're going to continue to look at data. We work very closely with Ira still. He can't leave me, so Ira's stuck with me for the duration of this program. But we really do look at the data. I know we've got Reinvestment Fund just finished another market analysis. And so these are all things that we're using to help explain to not only our elected leaders, but to our residents as to the when, why, and the where we're deploying our city-owned funds and how we can better support and partner with them. That's it for me. Take any questions, and I'm sure it looks like there's a lot in there. So I think that might have time for all of us to jump in somewhere.
I'll throw in just a couple of quick questions, and I think we'll probably will not get to all of them, so we'll give a chance to close up. But Peter just wanted to know, how did the data help in discussions with developers as they search for subsidies with the city council?
Yeah, so the conversation with developers has been, and Ira kind of alluded to it too. So one of the things that has been great, particularly as we looked at some of these oversupplied areas, partners like the Philadelphia Housing Authority is able to buy pretty much brand new market rate buildings at a much lower cost than they would to develop themselves. For instance, I think they are coming in at a $550,000 per unit rate for building, and they've been able to buy at least a few buildings at in the 200,000. And so that's one of the things, that kind of data has been really helpful. And then it's been really helpful, I think, for me in just kind of showing in some of the council districts, because obviously they're kind of large. You've got some that the northern portion of the council district has a different problem than the southern portion. And sometimes when you're looking at policy, you're thinking about the whole district. And we were able to then talk about why we needed to deploy different programs in different areas. And then working with Turn the Key, the data is really helpful because we have to do requests for proposals for developers to then come in and do this. And you're asking somebody to build something at a very set price. We've got to be able to show them the numbers and how it'll work for them.
Thanks, Maggie.
Fascinating. Okay. Well, so we do have many, many more questions that came in, but it is 2:58 and we want to be conscious of respectful of everybody's time. I want to thank everybody, Mark, Angela, Ira, for joining us for this session. This is a session that we actually did at the housing conference in Dallas. Mark wasn't able to join us, and it was very well received there. And it was the impetus for saying, hey, let's do it as a webinar format and see, get more people exposed to the fact that we have this data available. So the study that was done in 2025, I was going to say 2005, and the data for the 350 cities can be found at PolicyMap. As I mentioned earlier, the data is available in our mapping application, as well as within data packages, including on Snowflake. And I think one of the most exciting things, AI can make one both incredibly anxious while also excited at the same time. We have prioritized making this data AI ready so it can be accessed in other ways beyond a map, right? Other ways to gain insights from this. If you're using an AI chatbot, that sort of thing. So stay tuned on that. But if anybody wants to learn more about the data or has any additional questions, we'll get to all the ones that we didn't get to today. But reach out with anything further.
Thanks,
Any
Maggie.
parting
Thank
words,
you.
anyone? Okay.
Thanks so
Thank
much
you
for the
all.
opportunity.
I
Take care
really
now.
appreciate it. Okay.
Thank you.
Thank you.
Thank you.
Bye.